Are you holding on to cash thinking it's the safest option? Warren Buffett might have a different opinion on that. In 2026, keeping large amounts of cash in savings accounts could be a risky move. You see, inflation isn't always visible, but it's powerful. While your account balance might seem stable, the value of your money is shrinking. This video explores why cash could be more harmful than you think. Let's break down the real reason why holding cash might cost you in the long run. You've probably been told that cash is king, right? But is cash still the king of wealth preservation in 2026? Warren Buffett, the man who mastered investing, thinks otherwise. Holding cash might feel safe, but there's something we're all missing. Inflation, often quietly working in the background, eats away at your purchasing power. Many savers don't realize that inflation can reduce your wealth even when your balance stays the same. While market volatility grabs the headlines, inflation operates under the radar. The truth is, the interest you earn on cash often doesn't keep up with rising prices. That means, in real terms, your wealth is shrinking over time. But how do we balance this risk with the need for security? Buffett's approach to investing might hold the answer. He's known for his long-term view on money, and it's time we learn from it. The key idea is understanding the difference between real versus nominal returns. Nominal returns look at the face value of your savings. Real returns, however, consider the actual purchasing power of that money. In simple terms, inflation turns your nominal returns into smaller real returns. While your savings might seem solid, they're actually losing value over time. Buffett believes that you can't afford to hold too much cash, especially in an inflationary period. But if not cash, then what should you hold to protect your wealth? The answer lies in productive assets. Things like businesses, diversified funds, and income-generating investments. They not only preserve your wealth, but grow it over time. Think about it. Cash sitting idle doesn't create value, but assets like stocks, real estate, or even well-managed funds can. In 2026, there's no excuse to keep too much of your money sitting in cash. You need to make your money work for you, not the other way around. But it's not just about going all in on the stock market. It's about balancing liquidity with long-term growth. Major investors like Buffett don't just park money in cash reserves. They think long-term, investing in things that generate returns over time. Cash can be part of your portfolio, but it should never be the entire portfolio. So the question is, how much cash should you really hold? And how can you protect your wealth from inflation in 2026? The key lies in understanding how the rich balance their assets. But don't worry, we'll dive into those strategies in this video. Get ready to rethink the way you handle your savings. After all, Buffett didn't build his fortune by sitting on cash. Stay tuned because we're about to uncover the smarter ways to save and invest in 2026. Let's get deeper into the hidden dangers of holding cash in 2026. While it might seem like a secure option, cash has a silent enemy, inflation. Inflation doesn't announce itself, but its effects are very real. Many savers don't realize how inflation slowly erodes their purchasing power. If the interest you earn is less than inflation, you're losing money every day. The worst part, it happens without you even noticing. Imagine holding $10,000 in a savings account, earning 1% interest. On the surface, it seems safe, right? But with inflation running at 3%, your money is actually shrinking in real value. Over time, that $10,000 buys less and less, even though the account balance stays the same. The truth is, inflation has a much more significant impact than most realize. Your money might not disappear, but its value certainly does. This is the hidden risk of holding too much cash, especially in an inflationary environment. And if you're thinking this is a short-term issue, think again. Inflation is a long-term reality, and it's not going away anytime soon. So what's the alternative? Instead of keeping your wealth in cash, consider assets that grow with time. Buffett and other successful investors know this secret. Assets are the key. Things like stocks, real estate, and even businesses provide growth over time. These assets fight inflation by increasing in value while cash stagnates. But it's not just about buying random assets, it's about smart, well thought out investments that offer long-term growth. This is where most savers go wrong. They don't see cash as a potential liability. The longer you hold cash, the more inflation chips away at its value. So instead of playing it safe, you're actually taking a huge risk. And it's not just inflation that's the problem. Cash is also vulnerable to market volatility, especially in low interest periods. Your savings are exposed to fluctuations without the potential for real growth. In contrast, assets like stocks and bonds provide that opportunity. They offer returns that outpace inflation, making them a smart choice for long-term wealth preservation. If you're still holding too much cash, it's time to rethink your strategy. Savers need to start looking at their money from a long-term perspective. You can't just park your wealth and forget about it. The market isn't as volatile as some might think. Long-term investments are far more stable. The key is to balance your portfolio with both cash and assets. Cash has its place for emergency savings, but it shouldn't dominate your portfolio. By diversifying your wealth across assets, you ensure it keeps up with inflation. And that's how smart investors protect their purchasing power over time. The bottom line is simple. Cash alone can't protect your wealth. You need a well-balanced portfolio to keep up with the rising cost of living. Diversifying into productive assets is one of the best ways to beat inflation. But how do you make sure you're investing in the right assets? That's exactly what we're going to break down in the next part. Stay with us to learn how to properly allocate your wealth, because in 2026, cash is no longer king, and it's time to adapt. So now that we know cash alone isn't the answer, what should you do? The key is to strike the right balance between cash and assets. But what exactly does that balance look like in 2026? It's all about liquidity and growth. You need enough cash to cover your short-term needs, but not too much. The rest of your wealth should be invested in assets that generate returns. Think about it like a safety net with long-term growth potential. You can keep enough cash for emergencies, but the majority should be in investments. That way, your wealth is working for you, not sitting idle. So what are some of the best assets to hold in 2026? Stocks are a great option, especially if you're investing for the long term. They provide the potential for high returns that can outpace inflation. But stocks also come with risk, which is why diversification is crucial. A diversified portfolio ensures you're not putting all your eggs in one basket. Real estate is another excellent choice for long-term growth. Properties tend to appreciate over time, even when inflation rises, but it's important to be strategic about which properties to invest in. Focus on areas with strong growth potential and steady demand. Bonds are also a solid option for more conservative investors. While they don't offer the same growth potential as stocks, they provide stability. And let's not forget about income-generating assets like businesses or funds. These assets can provide a steady stream of income, helping you stay ahead of inflation. But again, the key is finding the right balance. You need to have a clear investment strategy that fits your goals and risk tolerance. This isn't about gambling with your money, it's about being strategic. That's what successful investors like Buffett do. They don't just buy assets, they buy the right assets. They focus on long-term growth, not short-term fluctuations. And they never hold too much cash, no matter how tempting it may seem. It's important to understand the role that each asset class plays in your portfolio. Cash is important for liquidity, but it shouldn't be the majority. If you have more cash than assets, you're missing out on growth opportunities. A smart investor knows when to move from cash to assets to maximize returns. And it's not just about the amount of cash you hold, it's about how you use it. Too much cash can become a liability if inflation eats away at its value. So start thinking about your savings in terms of assets, not just cash. Every dollar you hold should be working towards your financial future. And by properly balancing cash and assets, you ensure that it does. But here's the thing, this is a long-term strategy. It's not about quick fixes or jumping on the latest trend. It's about smart, disciplined investing that protects your wealth over time. That's the strategy Warren Buffett has followed throughout his career. It's why he's one of the wealthiest people in the world. So how can you implement this strategy today? Stick with us, because in the final part, we'll show you how to take action. Now that you know the basics, how do you put this into practice? So, the first step is to evaluate your current financial situation. How much cash do you currently hold? And more importantly, how much of it is earning value? Take a hard look at your savings and see if it's working for you. If not, it might be time to start shifting some of that cash into assets. Start with low-risk investments like diversified funds or index funds. These offer long-term growth potential while reducing exposure to market volatility. Next, consider putting some money into real estate. Start small, especially if you're new to the property market. Look for areas with steady growth potential, not just hype. And if you're interested in business, think about income-generating assets. These assets can provide you with a consistent cash flow. But it's important to choose wisely. Invest in businesses that you understand. Once you've got your assets in place, the next step is to stay disciplined. Don't let market noise distract you from your long-term goals. Keep your investment steady and avoid the temptation to cash out during downturns. Remember, investing is about patience and consistency, not speed. Warren Buffett didn't build his wealth overnight, and neither will you. The key is to focus on long-term growth, not short-term gains. So if you're holding too much cash, it's time to act. Start by moving a portion of it into investments that will grow over time. You don't need to take huge risks. Start small and gradually build. And remember, the most important thing is to stay informed. Keep learning, keep adjusting your strategy, and stay disciplined. As inflation continues to rise, it's more important than ever to protect your purchasing power. Don't let your savings lose value just because it feels safe to keep cash. By shifting your wealth into assets, you'll be setting yourself up for success. Whether you're saving for retirement or just building wealth, this strategy works. And in 2026, it's a must if you want to stay ahead of inflation. So take control of your finances now and don't wait until it's too late. Shift your mindset from holding cash to building assets. That's how you'll protect your wealth and grow it for the future. Warren Buffett's approach isn't just for the rich, it's for anyone willing to think long term. And now that you know the secret, it's time to apply it to your own life. Start investing in things that will increase in value. Diversify your portfolio and balance it with both assets and cash. The sooner you start, the sooner you'll start seeing the benefits. Because in 2026, the smart money isn't sitting in cash, it's in assets. Don't let inflation eat away at your savings. Make your money work harder for you. Just like Warren Buffett, it's time to stop waiting and start investing. Take action now to secure your financial future. If you want to protect your purchasing power, there's no time like the present. So what are you waiting for? Start today and take control of your financial destiny.